back to Iron Financial. This is the channel where we forge stronger portfolios by cutting right through the market noise. I'm your lead analyst, and here with me, as always, is our market skeptic. Today, we are putting Caledonia Mining squarely under the microscope. They just released their full year 2025 results, and there's one number that's just blowing up the headlines: a mind-boggling 193% surge in profit. Now, on paper, that looks like an absolute home run. But you know our job here isn't to just read the headlines, it's to stress test them. So today, we're going to take a sledgehammer to the foundation of this company. We're going to search for every single structural crack and determine if this is a bedrock opportunity for your portfolio or if it's just a very well-disguised trap. Let's get right into it. Okay, let's start with the number that got our attention in the first place: plus 193%. That, right there, is the year-over-year growth in profit after tax. Now, let me be clear, you just don't see figures like this pop up every day. Not even in a crazy, volatile sector like gold mining. This isn't just a slight beat on expectations, this is an absolute blowout. It's the kind of number that demands you stop what you're doing and pay attention. But a number this big can mean one of two things. It could signal a company that is just firing on all cylinders, an absolute machine, or it can be a beautiful, glittering mask that's hiding some really fatal flaws underneath. Our whole mission today is to figure out which one of those it is. And that's exactly why I'm here, a 193% profit jump. I mean, of course, that looks incredible on the ticker, but I feel like I've seen this movie a dozen times before, and it doesn't always have a happy ending. You know, the most glittering, shiny prizes are often the most dangerous traps. So the question we have to ask is this real? Is this sustainable growth that's built on a solid, unbreakable operational foundation? Or is this just a temporary sugar high? You know, a company getting lucky with record high gold prices? Are there hairline fractures just below the surface that the rest of the market is just conveniently choosing to ignore? My job is to be the voice for every single investor out there who's watched a stock go absolutely vertical right before it drives off a cliff. So let's ask the real question. Is this a true golden opportunity, or is it just a trap waiting to spring on unwary capital?
Those are all fair questions, and that's why we're going to start by building, or let's say forging, the bull case from the ground up. We're going to examine the raw materials that make up this entire financial structure. We're talking revenue, we're talking cash flow, we're talking about the balance sheet itself. For just a minute, I want you to completely forget about the stock chart, forget the day-to-day noise, and let's focus on the bedrock fundamentals that they just reported in their full year 2025 results. Because any structure, whether it's a building or a company, is only as strong as its foundation. So let's get in there and examine the pillars that are holding up that staggering 193% profit figure. It all has to start at the top line. I mean, nothing else matters if the revenue isn't there. For 2025, revenue clocked in at $267.7 million. That is a massive 46% increase from where they were in 2024. Now, what is absolutely critical for you to understand right here is how they got that number. This wasn't because they were digging a whole lot more gold out of the ground. In fact, their production volume was actually pretty flat year over year. This entire revenue surge, this tidal wave of cash coming in the door, was overwhelmingly fueled by one thing: a very, very strong gold price environment. The company realized a much higher price for every single ounce they pulled out of the ground and sold. They turned those favorable market conditions directly into revenue. This is the first, and you could argue the most powerful pillar of the entire bull case. They are capitalizing heavily on the current market for gold. But you know the old saying on the trading floor: revenue is vanity, profit is sanity, but cash is reality. This number you're looking at, $62.1 million, is the free cash flow for 2025. You really need to understand, this is the absolute lifeblood of any capital-intensive operation, especially a miner. This is the cold, hard cash that's left sitting in the bank after every single bill is paid, after every salary is met, and after every necessary investment to just maintain the mine is made. It's not some accounting trick, it's not a number on a spreadsheet, it's real money. And real money gives a company strength, it gives them flexibility, and it gives them the power to reward their shareholders. A strong free cash flow number like this tells you the business isn't just profitable on paper, it's a powerful cash-generating machine in the real world. And that powerful cash flow leads directly to this next point, which is just a complete and total transformation of their balance sheet. Just take a look at this. At the end of 2024, Caledonia had a net debt position of $8.7 million. Simple terms, they owed more money than they had in the bank. Now, fast forward just one single year. Look at the right side. They have completely wiped out all of that debt and are now sitting on a net cash position of $23.8 million. This isn't just a small improvement. This is a monumental shift in the company's financial health. They've gone from being a borrower, being on the back foot, to having a significant cash fortress. That de-risks the business enormously.
It's one of the clearest signs you can find of extreme financial discipline and really robust operational health. And finally, for the bull case, let's look at what I call the steel reinforcement in this entire structure, the dividend. For all you income investors out there, I know this is a non-negotiable. Caledonia has once again declared a quarterly dividend of 14 cents per share. Now, just look at this history here. Since late 2021, through all the market ups and downs, through inflation, through global uncertainty, that 14-cent payment has been rock solid, quarter after quarter. A company that can generate enough cash to fund all of its operations, completely obliterate its debt, and consistently reward its investors with a dividend check, well, that's a company that appears to be firing on all cylinders. This track record of rewarding shareholders is a core, fundamental part of the bull case. All right, I'll give you that. You've built a pretty impressive-looking fortress, analyst. You've got record profits, you've got cash gushing out of the operations, a cash-positive balance sheet, and a dividend as regular as clockwork. The bull case is definitely clear. But you know that here at Iron Financial, we don't just stand back and admire the architecture. No, we bring in the demolition crew to test its strength. So now it's time to run a full structural stress test on this thing. You see, any fortress looks imposing from a distance. It's only when you got right up close and you start tapping the walls and looking for those hidden fault lines that you find the real weaknesses. Let's get to it. Now, before we go a single step further, we have to talk about maybe the most critical metric for any serious mining investor. It's called the all-in sustaining cost, or AISC for short. You have to understand this number. This is the figure that separates the truly world-class operators from the pretenders. It's not just the simple cost of digging rock out of the ground. No, it's everything. It's the mining, it's the processing, it's the fancy head office salaries in another country. It's all the capital you need to spend just to keep the mine from falling apart. It's the all-in, no excuses, total cost to produce 1 single ounce of gold. A low AISC is a sign of incredible efficiency. A high AISC, well, that's a massive warning sign. And this brings us to the very first major crack we found in Caledonia's foundation. Yes, the realized gold price of over $3,300 an ounce is absolutely fantastic. I'm not denying that. But you have to look at the other side of that equation. The all-in sustaining cost for Caledonia was $1,952 per ounce. Let me be perfectly clear. That is high. It is very high. What this means is that their profit margin, while it looks really fat and healthy right now, is entirely dependent on a continued, historically elevated gold price. The key takeaway, the thing you have to burn into your brain is this. What happens if the gold price corrects? What if it pulls back to $2,500 or $2,200 or, heaven forbid, back to $2,000? Their impressive profitability evaporates, and it evaporates fast. This high-cost structure makes them incredibly vulnerable to the whims of the gold market. The fortress is built on a golden foundation, but that foundation might be a lot softer than it looks. Next, we have to talk about a risk that transcends any financial statement. In September of 2025, a fatal accident tragically occurred at the company's Blanket mine. Now, first and foremost, this is a human tragedy, and we can't lose sight of that. But for you, the investor, it is also a massive red flag. It highlights an extreme level of operational risk, and it raises very serious ESG, that's environmental, social, and governance, concerns. An incident like this isn't just a news story. It can trigger operational shutdowns, it can trigger government investigations, and it can bring intense regulatory scrutiny down on the entire operation. The company says they've launched a review, but this is just a stark, brutal reminder of the inherent dangers of operating a deep underground mine, a risk that carries potentially devastating financial consequences. Okay, now let's bring out one of our heavy-duty diagnostic tools. This is something called the Benish M-score. And I can guarantee you, you will not find this metric mentioned anywhere in a company press release. It's a forensic accounting model that was specifically developed to detect potential earnings manipulation. It works by using a complex combination of 8 different financial ratios. And it's looking for signs of trouble, things like rapidly increasing accounts receivable, declining gross margins, or unusual accounting accruals. You can think of it like a statistical red flag detector for aggressive or sometimes even fraudulent accounting. Generally, a score below -2.22 suggests a company's books are clean. But a score above that threshold, well, that demands some serious caution. And here it is. This is the single most concerning piece of data that we uncovered in our entire deep dive. According to a third-party analysis from Guru Focus, Caledonia Mining has a Benish M-score of 1.33.
Now, let me be absolutely crystal clear about this. This does not prove that there is manipulation. We are not saying that. However, for any serious analyst, a score this high is a five-alarm fire. It strongly suggests that the company's financial statements exhibit characteristics that have historically been associated with companies that were manipulating their earnings. The quote says it all. It warrants further scrutiny. So think about this. We have a company posting this incredible 193% profit growth, while at the very same time, a trusted forensic model is flagging the quality of those exact earnings. This is a deep, structural crack in the foundation that we absolutely cannot ignore.
That's a very serious point, and one that absolutely requires a much deeper dive from any potential investor. But while we're examining the risks that exist in the present, we also have to look to the future. You know, a company's value isn't just about its last quarter, it's about its plan for the next decade. For Caledonia, that entire future rests on a massive new project called Bilboes. This is their grand blueprint to transform themselves from a small, single-asset producer into a multi-mine powerhouse. But blueprints, as we all know, can be deceiving. So let's scrutinize these plans and see if they actually represent a solid path to growth, or if it's just an impossibly heavy lift.
So, the very first thing you notice when you look at these grand blueprints is something a bit puzzling. For all this talk of transformational growth, the immediate future looks, well, flat. Production in 2025 came in at just over 76,000 ounces, but their official guidance for 2026 is a range that's between 72,000 and 76,500 ounces. So the absolute best-case scenario is basically zero growth, and the worst-case scenario is a slight decline in production. This immediately raises a critical question. If production isn't growing in the near term, where exactly is this growth story coming from? It tells us very clearly that all of the company's hopes and dreams are pinned on the successful and timely execution of the very large, very complex, and very expensive Bilboes project. And that brings us to the price tag on those blueprints. This chart right here puts the challenge in really stark visual terms. On the left, you have that impressive $62 million in free cash flow they generated in 2025. We were just talking about it. But on the right, you have the planned capital expenditure, or capex, for 2026, a staggering $178.9 million. The math here is brutal and it is unforgiving. The cash that the business is actually generating doesn't even come close to covering the cash they plan to spend. There is a massive funding gap of over $100 million. So the question is simple, and it's one they have to answer. Where is that money going to come from? This isn't just heavy lifting, this is a Herculean financial task that's going to require a massive infusion of outside capital. So let's just spell out the risks that are sitting right there on the horizon. First, you've got that capital commitment of nearly $180 million. It's huge. Second, there's the explicit need for additional funding, with the company themselves admitting they're looking to raise up to $150 million more. Now, that money has to come from somewhere. It means either taking on a mountain of new debt, or it means diluting current shareholders by issuing a ton of new stock. Third, there's simple execution risk. Building a brand new mine is brutally difficult. Delays and cost overruns are basically the rule, not the exception. And finally, to secure some of their financing, they've had to implement a hedging program. Now, this protects them if gold prices fall, but it also puts a cap on their upside for 3,000 ounces a month. So if gold rips to new all-time highs, they won't get the full benefit. These are not minor concerns. These are significant hurdles standing in the way of future growth. Okay, we have laid out the bull case, the undeniable strength that we see in the 2025 results. And we've stress-tested that structure, exposing some very serious potential weaknesses and some pretty daunting future risks. We have the solid foundation, and we have the dangerous fault lines. So it is time to step back, to weigh all of the evidence, and to deliver the iron financial verdict. Is Caledonia Mining a fortress of profitability, or is it a carefully constructed trap just waiting for the market to step in it? What you're looking at right here, this image, it perfectly captures the core conflict of this entire investment thesis. On the one hand, you have this, pure, tangible value. The company is actively pulling gold from the earth and turning it into record profits and massive cash flow. That is happening right now. It is absolutely real. But on the other hand, the process of getting to this point, of pouring that gold, is absolutely fraught with risk. The costs, as we've seen, are dangerously high. The operational dangers are tragically real. The accounting has been flagged by a sophisticated forensic model, and the future plan requires a staggering amount of capital that the company simply does not have. That molten gold is real, but so are the fires you have to walk through to get to it. So let's put it all on the scales. In the structural strengths column, the evidence is undeniable. A 193% profit jump, $62 million in free cash flow, a complete swing from owing money to having a $23.8 million net cash position,
and a rock-solid 14-cent quarterly dividend. This is the resume of a company that is executing at a very high level in a very favorable market. But on the potential fault line side, the risks are just as stark. The all-in sustaining cost of nearly $2,000 an ounce creates extreme vulnerability to the gold price. The fatal accident raises major operational and ESG flags that can't be ignored. That Benish M score is a serious accounting red flag that, frankly, simply cannot be dismissed out of hand. And the entire future growth plan carries enormous capital and execution risk.
So this is the fundamental question that you, the investor, must answer for yourself. We've laid out all the facts as we see them. The company has undeniably forged a powerful financial engine in 2025. The question now is whether that engine is strong enough to carry the immense weight of the Bilboes project while navigating the very real cracks we've identified in its foundation. Is the current strength a solid base for future growth, or is it just a temporary facade that will crumble under the pressure of high costs, execution risk, and that troubling Benish score? The materials are all here on the table. The final judgment is yours to make. Make sure you do your own diligence. That's all for this edition of Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.